and that means we are live here on our YouTube channel, Tackle Trading's Halftime Report. Welcome back. Yesterday we had some technical difficulties. I don't know if it was YouTube or Zoom that we ran into, so we ended up recording the halftime show, uploading it. Hopefully those out there that are watching our show right now that are regular Team Tackle, you got a chance to see that as well. But we are back. We are live. We are ready to rock and roll. There is a lot of action we got to break down. In today's market, hints at infrastructure and some rumors around that. We're going to be talking about that. $1 trillion package is kind of being talked about from the Trump administration, the government and whatnot. We'll break that down a little bit. Jerome Powell, by the way, not to ruin the podcast or one of the candidates for Clown of the Week, though, in our game yesterday on the podcast, he's back in front of the Senate Banking Committee and talking on the Capitol Hill about Fed policy, fiscal policy, what he sees with small businesses, the economy, and all those kind of things. The Fed has been in the focus now for several months, in fact, for 15 years, if you think about it. But really, I mean, they're the ones driving this market over the last several days. We'll break down some of his commentary and action. Data, I got to tell you guys, and I can't wait to get Matt's take on this. Retail sales, industrial production, housing numbers, pretty impressive. We'll break down all the numbers, all the charts, have some fun while we're doing it, and welcome out everybody. A couple things before I kick it over to the coaches. If you're watching our channel for the first time, subscribe. We're like 100 away from a goal that we've set as a team. We want to get to that mark. And so if you're not a subscriber yet, click the subscribe button, click the bell, come back and join us each and every day. We do this show each and every day live. I think you're going to love it. You'll love the content we put out on our channel. Got Matt, got Mark, got Cody. Noah's going to be popping in here shortly. Matt, how you doing today?
Tim, I'm doing good. I'm excited to be here for the halftime report, and less excited to listen to Powell lie on Capitol Hill, but I am excited to be here for the report.
I don't even turn that stuff on. I got to tell you, I'm a headline guy. I'll go read the data after. I'll have Mark break it down. You break it down for me. I can't watch him take questions from senators. It's just not. It's not me. It just isn't. Do you go through it, Matt? Do you watch it?
I do. I geek out on that stuff. I have not been watching his testimony yet. I will watch it later on today. Have a few things I got to take care of today, but I will catch up on everything he has to say in his speech later today. I've seen the headlines, but this is a semi-annual testimony he does when he goes to the Senate Finance Committee, and then he speaks to the House tomorrow. So it will be fascinating what he has to say in his testimony. But if the first thing I read is indicative of what he's going to say later on throughout the next 2 days, that he doesn't want to run through the bond market like an elephant. What does that look like, or what does that not look like? I mean, with what the Fed announced yesterday and what they've been doing, I mean, they're the only player in the bond market at this point. And eventually they might be the only player in the corporate bond market. And eventually they might be the only player in the stock market. And, eventually they might own 50% of the entire equity value of the financial world. Who knows? Who knows where the end goal here is?
Yeah, it's pretty crazy when you think about it. He doesn't want to run like an elephant through the bond market. I did not hear that phrase, but that definitely does paint a visual. I'm sure that Matt, that you believe that they probably are going to be doing that. Mark,
if he's trying to steal Marty the elephant from me, he's got a fight on his hand. I'm not going to fight the Fed on much, but if he's trying to steal my elephant, oh, it's on.
I thought the phrase was "Don't be a bull in a china shop," but I guess elephant in the bond market does work.
Apparently Powell and me have something in common then, because I have a tendency to do that too.
Just kind of mix stuff up. Marky, I want you to come on in here and give us the analysis, the headlines, the information. What is Powell saying today? Let's start with the testimony. We'll break down some of the other Fed actions as well. But what are you learning about the Fed today? What is he talking about?
Well, I'm not learning anything, to be honest, because it's not a whole lot different than dude, the Fed has it. There haven't been any real deviations or variations in Fed speeches for 6-7 weeks now. They've been pretty on point. Like I love how last Thursday when Powell spoke, they're like, well, the market's down because Powell sounds so down about things. They've been pretty dire about how the situation all throughout. He says that output and employment rate remain far below economic pre-pandemic levels. He says there are some signs of a modest rebound in the economy. Once again, it's like this coming off the floor. I'm sure we'll talk about retail sales coming up, but it's like And I've seen the same thing in airlines as well. It's like, well, airline passengers are picking up. And I'm like, I would hope so. They were almost at zero. Like, and so it's like this, things are doing better. I'm like, the whole world shut down for a month. Of course, we're doing better than we were in April, because it would be almost impossible to do worse without a catastrophic event happening. So he is basically today in all the headlines saying everything we know already. The economy is in rough shape. The Fed's going to do everything it can to move it forward. Government needs to do more fiscal stimulus. Basically, rinse and repeating everything that have been coming out of his mouth and the other Fed chair people's, other Fed members' mouth for the last 6-7 weeks. They have a script. They're sticking to it. I don't think you'll see any deviation from it the rest of the year.
It's real interesting. Go ahead, Matt.
He did say one thing that was interesting. He was asked a question regarding, the market participants and the risk on behavior of the market. And he said, basically, he said, quote, in response to that question regarding the risk investors are willing to take in this economic environment, he said, because they believe we'll do what we say we're going to do. Well, if we believe what they say they're going to do, the Fed's going to continue to own the bond market and run through it like an elephant sniffing for opportunities in the bond market. So it's fascinating to see, the dovish response from the Fed. I never thought we'd see a more dovish Fed president in the time. I'm talking 08, 09, 2010 through really kind of 2013 when you did the new quantitative easing coming into the market. But what the Fed is doing now is just unprecedented in American history. It's not unprecedented in world history. We've seen this play out. And I've given the analogy of the Bank of Japan before, but what the central bank is doing is the Japanese playbook. And we've seen the results in that. In the immediacy, I mean, the market's going to respond bullish, no doubt about that. But does this have a longer term impact that the Fed is not projecting? And so there's a concern here longer term. But until we start to see the market response to the Fed any different from a buyer's mentality, it's kind of like, Tim, we were talking about in the pre-production show. You're like, it's hard to trust your eyes to a certain extent, but you got to trust your eyes right now. You have to trust your eyes right now. And until the Fed, takes off from the pedal, you got to buy here. You got to buy yesterday. You got to buy dips. You got to buy support bounces. And until trends and patterns change, until support is truly violated, you got to trust your eyes more than anything else.
Yeah, we're in a bullish trend. There's no question about it. The patterns are bullish. That's a bullish retracement. We broke that down on the podcast yesterday. We'll talk about the podcast here in a few minutes with Noah. We've talked about the technical conditions here on the halftime report over the weekend. How many great patterns and great setups did we have on stocks that were in bullish retracement patterns? So, and the rankings, even in the newsletter, even with the sell-off on Thursday, we maintain bullish rankings. So, I mean, we are seeing the markets as bullish as traders. There's no question about it. The backdrop of the fundamental problems, that's the big, discussion that we could spend forever on. And obviously we do break that down one step at a time. But what's interesting about what you just said, Matt, it kind of made me think, Powell was supposed to be the hawk and we have the most dovish Fed probably in the history of my life, at least that I can think of. When he was appointed, he was a hawk. He was going to come in, shake it up and all that kind of stuff. Maybe modern economics just breaks these guys down to where they just got to flood the markets with money. I don't know. That's a longer discussion than I want to have right now. But there's no question it's been dovish, and we're seeing the impact of that the last few days. That direct bond purchasing, Matt, was huge news yesterday. And obviously it found a little bit of a support point and whatnot. Explain that a little bit, because I don't think everybody understands what it means for the Fed to be buying direct corporate bonds.
Well, I mean, this is the step-by-step approach the Fed is taking until they start directly buying equity, in my opinion. It was fascinating to see the Fed over the last, not yesterday, it was fascinating to really kind of, watch the Fed over the course of last Wednesday until today. Last Wednesday, they came out with monetary policy and they made no significant changes to monetary policy. They didn't change the interest rate. The only thing they announced yesterday, not yesterday, but they announced last Wednesday, was they were going to increase the amount of quantitative easing they were going to do on a monthly basis, upwards of 120 to sometimes 160 billion dollars. which is a radical number when you talk about historical quantitative easing. I mean, at the height of 2013, 2014, we were buying about $85 billion worth of bonds on a monthly basis, expanding the balance sheet by about 85 billion. But last Wednesday, outside of just those normal, we're going to increase the liquidity in this, you really didn't see anything radical coming out of the Fed. They reassessed what their economic projections are. They talked about how the labor market is going to take years to recover, how the economy is going to be a U-shaped recovery. But again, they didn't say anything that was, unprecedented. They didn't say anything that was unexpected. But what was interesting is to see the market sell off on Thursday. And then when you take into account what they announced yesterday, that they're going to start buying immediately corporate bonds, and upwards of about $700 billion worth of corporate bonds. By the way, with very little transparency coming out of the central bank. And they haven't talked about exactly how they're going to be purchasing those bonds. Like I said, there's been very little transparency in how this corporate bond program is going to actually work. But at the end of the day, they wait till, and what was fascinating to really kind of read the Fed over the last few trading days is, in my opinion, the Fed was waiting until they saw the market response. They wanted to see how the market was going to respond to what they said about the economy on Wednesday, which again did not update anything. They basically reaffirmed what their original opinion of where the economy is going to be, where the labor market's going to be, where manufacturing is going to be. So nothing new came out on Wednesday. They wanted to see how the market responded on Thursday. And then over the weekend, when we started to see volatility shift to the downside again, shockingly, as the market starts to show a little bit of negative movement to the downside, here's the Fed coming out and just literally saying, okay, now we've seen the market response. We don't like it. Now let's announce that, $700 billion corporate bond buying program. I cannot be convinced that the Fed was not going to wait to see the stock market response before they announced a corporate bond movement. They could have putting in a plan to go to buying and purchasing directly corporate bonds. That is not something you come up with from a Thursday to a Monday. That's been in the works for months and months and months and months. They waited to make the announcement until the market sold off. And that just leads me to truly do believe that everything the Fed is doing right now, maybe not everything, but the vast majority of what the Fed is doing right now is directly to aid the 1% of the market, the top of the market, to keep the stock market afloat, that it's not designed to aid the economy from a bottom-up economic approach long term. It's not. Powell talking last Wednesday about how he represents the people and everything they do is for the people, and so on and so forth. It's disgusting. It's absolutely disgusting to listen to Jay Powell sit there and in one side of his mouth talk about how he's for the people, doing everything for the people, how he represents the people. Jay Powell, let me remind you, you're not an elected official by the people. You don't represent the people. The Central Bank of the United States does not represent the United States, and the United States government has no accountability to what the central bank does. The United States has no decision in what the central bank does. They have no elected representatives on the central bank. You don't represent the central bank, Jay Powell. You represent 5 major families, and you represent the stock market. That's what Jay Powell does. So this him even saying that really just makes me cringe a little bit, because when you look at what the Fed has done just yesterday, it is so obvious. It is so obvious that every time the market responds, every time those whiny little babies on Wall Street throw a little bit of a temper tantrum, the Fed comes in and they spoil the child. They let this horrible behaving child just do whatever it wants to do, i.e. the stock market. And it's okay, Billy. It's okay, Billy. You want to go punch somebody in the face. That's okay, Billy. They instigated it. They literally just let this spoiled little baby on Wall Street do whatever it wants to do, not care about fundamentals, not care about valuation, not care about risk, not care about leverage, not care about margin, not care about anything. Just push all those chips to the middle of the table. The Fed is an absolute joke. They've lost all credibility, in my personal opinion, but they're the most powerful player in the bond market. They're the most powerful player in the stock market right now. In fact, find me a market they're not the most powerful player in at this point.
Natural gas.
Eventually they're going to start. Eventually they're going to be buying natural
No,
gas contracts.
and the thing about it is, if I thought that their programs would help, all they're going to do is, okay, coming into this crisis, it was widely known that companies were over leveraged with debt to begin with. Companies' balance sheets aren't going to be healthier after this. They're going to be worse because they now know, hey, the Fed's going to buy any debt we issue. So get ready for buybacks to come, get ready for unsustainable debt. It's absolutely, I mean, it's making the next crisis even worse.
Mm-hmm.
You know, at one point when this all comes crashing down, 10, 15, 30, 50 years from now, who knows when, because it is.
6 months from now, Mark. I mean, nobody knows.
Nobody knows. But at some point, something really horrific is going to happen, and our economy, our U.S. debt, company debts are not going to be able to handle it, because we have to have immediate stock market highs today. And Matt, I absolutely agree. Do not tell me you're the people. Jay Powell, you and your ilk are and will be remembered, and I'm stealing this from Guy Adami, so it's not me. You will be remembered as the villains of the 21st century. Individuals that are laid off, hey, guess what? Your benefits are out the window. Corporations, congratulations. Here's more debt and more debt and more debt and more debt to do your financial engineering. This isn't healthy for, as an American, for our economy. It's healthy for my trading today. Hey, great, right?
Sure.
Up
Yeah.
again. Who isn't up lately on their bullish trades? Great for my trading. Great for my naked puts.
Great for retirement accounts.
You are not doing anything to help the output and the production and making America great. You are not. You are trying to put a Band-Aid on a gushing geyser, and you are absolutely a terrible human being because you are, and a terrible American because you are making this country worse. Hey, I'll make money, right? Because that's the game we're playing. But I don't like it. I don't like making money this way. I can make money lots of ways.
Well, I don't care where you come from. I mean, you have to be disconcerted with what has happened with our national debt, with the Fed balance sheet the last several months. There's no question about it. And, you know, him in front of the Senate, I don't watch those testimonies, Matt, but I can't wait to hear, you know, all of the wrap up. And by the way, it's not just today, it's tomorrow as well. He's going to be in there tomorrow as well. Guys, Fed actions aside, I mean, the market performance here has been really interesting, and the market reaction. You know, that technical chart, we obviously had the big day on Thursday. We came back into key moving averages, higher, you know, pivot low here, Matt. Confirmation even today as of right now at 1 o'clock Eastern Standard Time. Give me a read on the technicals if you can, Matt.
I mean, when you're looking at this purely from a technical perspective, it, you know, and I can't remember who I saw in the chat say it, but it's what Keith King always says. I think it was Zach, a good quote there. You know, you got to sometimes as a trader, especially short term, you got to discount the things long term that are concerning to you. Obviously, I mean, Mark, if you and I sat down for the next 90 minutes and we discussed the things that are concerning to us from a fundamental valuation, behavioral, or an economic or a monetary policy perspective, and all we did was list out the bullet points we're concerned with, I don't think Mark and I could actually get through a list of the things that we're actually truly concerned about long term. Would you agree with that?
Matt, I think that the United States of America could cease to be one day because of federal action that they are taking over the last 12 years. Now, with that said, so I have a very dire outlook long term. I don't have a single bearish trade on today.
Yeah, so that's kind of where I'm at too. I mean, you know, from a long-term perspective, it's very concerning what we're seeing from the Fed. It's very concerning with the balance sheet. It's very concerning with the amount of debt we're going through. It's very concerning in many capacities about valuations and forward PE ratios and debt obligations and, you know, all of these things from a fundamental perspective. But Mark, I don't think you're the unique unicorn in the fact that you don't have any bearish trades on, right? I don't think that's unique in this market. I think everybody is kind of seeing the same thing we are, that We're questioning the long-term valuation. We're questioning the fundamental conviction. We're questioning the, where is this market going to be 2, 3, 4, 5 years from now? And what is the Fed going to do in the future to constantly maintain? I mean, just think about it, guys. In the last just 2 months, the amount of new initiatives coming out of the central bank just in the last 2 months, the increases in quantitative easing, the increases in the balance sheet, now directly buying corporate bonds. I mean, the Fed, Jay Powell, rejected the notion for negative interest rates right now. They'll do anything in their power to not announce a negative interest rate, but then in every single one of their policies, they're trying to push interest rates down even further. Every single policy is meant to drive interest rates even lower and lower and lower. And let me remind the Fed that, hey, central bank, you don't have to announce a negative interest rate to go to a negative interest rate. And they know that. They don't want to announce a negative interest rate, but every one of their policies is indicative of a negative interest rate, and directly buying upwards of $700 billion in corporate bonds is a measure designed, because who else is buying corporate bonds right now? It's not just buying stock valuation. Who's buying the corporate debt right now? And so let me give you a case study here. Let's say I'm a corporation, guys, and I have massive amounts of debt. I've just had to lay off 10% of my workforce. We're going through the COVID-19 situation. I don't know about the fundamental nature of my company, and I need you to buy my corporate debt, and I'm willing to pay you hardly nothing to own my corporate debt. Who's going to buy that? Nobody. Here's the central bank acting like Superman, coming in and buying a bunch of junk bonds. I mean, because nobody else will do it. So obviously, everything the Fed is doing is trying to drive interest rates down without actually announcing a negative interest rate, because announcing a negative interest rate has negative connotations. It does. America has never announced a negative interest rate, but we've also never had a central bank to increase the balance sheet the way it has. We've never had a central bank to announce buying corporate bonds. So from that capacity, they're trying to drive interest rates lower and lower and lower artificially through the bond market, instead of actually announcing a negative interest rate. What I saw yesterday from the Fed leads me to have more conviction that we will see negative interest rates in American history for the first time. And most likely, and maybe it won't be announced from the central bank, but you can go negative interest rate. Bank of London did not announce a negative interest rate, but their bonds were pricing in negative for the first time last month. So everything the Fed is trying to do is try to drive the interest rate down even further and further and further through both their quantitative easing programs, their repo actions, and now through the direct purchasing of corporate bonds. And so, I mean, whatever the nuclear option was from the central bank 6 months ago, we've seen it. We've seen the nuclear option. This is that nuclear option, waiting for a one-day pullback in the market, for volatility slightly to increase just in the short term. And I mean, just the last 2 to 3 days, for the Fed to come out there and say, we are directly buying upwards of $700 billion worth of debt. What is the Fed not willing to do on any degree of volatile moment? Is there any level they are not willing? And the reason I ask, guys, is because that if your belief is the Fed is willing to do absolutely anything to further push asset prices up in this environment, if I don't hear that the Fed is not willing to do anything, you got to buy. You can't fight that level of liquidity coming into the market.
Didn't Powell last week say they don't care if the asset prices go higher? Like, they're just looking for functional markets.
He specifically said that it is not their job.
And
he also stated that monetary policy will not be determined based on where asset prices are. Again, you're lying through your teeth, pal. Everybody knows it. Stop lying. Tell the truth. It's not going to happen. But yeah, he did say it, and the question was specifically regarding the level of risk that market participants are willing to take. And he said it's not their job to determine that. And they're going to determine their monetary policy based on all the nonsense that they see. Obviously, the market has a risk on perspective right now. And basically what the Fed has done is they've confirmed two things. Number one, they're confirmed they're willing to do absolutely anything to further push asset prices up. And number two, the further those asset prices go up, they're not going to determine their monetary policy based on that.
Mhm. You know, there's two interesting charts across all the indexes that are grabbing my attention. I think like a 5 or a 15-minute intraday here on the S&P. Matt, grab me an intraday chart if you will, and then just the NASDAQ. Then we have to move to the NASDAQ as well at some point. I mean, you look at the reversal characteristics here intraday, guys. I mean, from Monday, from the Sunday night action, we talked about this yesterday in the halftime report. We were selling. We then started putting in higher pivot high, higher pivot low. The bond purchasing stuff pushed us into an uptrend, Matt. Now we're holding that a little bit. The cash open today did not hold everything, but then here in midday, we are now trying to find that pivot again. And now we're moving back into higher high, higher low scenarios here on the intraday. I see some weird momentum shifts in there. I've got Noah Davison who just popped into the halftime show. Welcome, Noah. As always, Noah, what are you reading in the intraday charts here on the market?
Hey, we talked about this in the Traders Lounge this morning. And one of the things we talked about was the overall slowing momentum pattern on about a 30-minute chart. We talked about the engulfing range it just put in where it slowed down first. And then that last little selling we saw this morning at the cash open, that engulfed the previous support zone. It took out that last run up. And so it created a megaphone pattern or an alligator pattern, which could warn of a reversal. It could be a continuation pattern. It's just a matter of whether it breaks out the top or the bottom. Yeah. So you get that kind of opening engulfing range exactly right there. And anytime I see that volatility shift, it's really kind of a volatile shift in a chart. It just warns me, hey, this could reverse. I don't think it's going to. I think it's going to power through the top. But that pattern is either a megaphone or an alligator, and I only call it a megaphone if it keeps going up. If it's a reversal, I call it an alligator pattern.
Mm-hmm.
Differentiate it, but right now it's trading smack dab in the middle of support and resistance on that chart, and so it'll be really interesting to see which way this market closes today.
Mm-hmm. The other interesting chart, Matt, is the NASDAQ, in my opinion. We were on the halftime report last week. I believe it was Wednesday or Tuesday when we hit that 10K mark intraday and we hit that all-time high. It would have been Tuesday, I believe, the day before the Fed. We're pressing up there again. I mean, guys, after everything said and done around the tech sector this week, at least, relative strength in the NASDAQ, Matt, we're only 45 points away from that $10,000 mark and about 60 points away from breaking out of that 10-1. Well, no, 160 points from the 10,155. Strength in tech. Matt, do you expect that to continue? I mean, is this just the area investors are seeing as a little bit better, safer, the Facebooks, the Apples, those types?
Absolutely. The NASDAQ has to be ranked number one. And if you're ranking those indexes, it's been ranked number one. It's not exactly the technology sector in the S&P, but when we rank the sectors in the S&P, tech has been the number one sector for months and months now. And quite frankly, tech will probably be the number one sector for the next 20 years, the predominantly majority of the time. So, I certainly like tech here. If you're looking at buying those dips, the 9,500, the 20-day moving average bounce on tech was really, really strong. The close yesterday on tech, when you look at the close yesterday, I mean, no sell day after the initial surge to the downside. But just buy up here towards the top. Continuation today, really not any profit taking you saw here today. When you're looking at it from an intraday perspective, you saw the pretty aggressive sell-off in all of the market indexes, but tech recovered quite aggressively later on in the trading day. And so absolutely, when you're looking at this market from, where do you see the strength of this market? The strength of this market has been in the tech rally. It's just from an intraday perspective today, just from a bounce yesterday, it's been the strongest of the indexes out there. So absolutely, right now, tech is the strongest of all of the sectors. It's the strongest of all of the indexes, and I don't think it's a close second, to be honest.
Mm-hmm. Next one I want to talk about is XLI, if you can, Matt, just a way to kind of bridge into a conversation about the infrastructure bill. Companies like Caterpillar and, cement-based companies and construction companies and big construction companies like that, Deere, those types might benefit from this. Mark, there's rumors and information about $1 trillion stimulus into infrastructure coming out of the Trump administration. What do we know about that at this point? How much of a reality is that going to become? What's your expectation? Mark, I want your take on this one first.
Well, anybody that's been in the market even just a couple years know that Trump has touted many times over his presidency an infrastructure plan. So a big, huge infrastructure bill has been on his agenda for some time. So I mean, this is one of those. I mean, we remember when U.S. steel spiked up to $44.
Mm-hmm.
You know, like there was like So this desire to have a huge, massive infrastructure bill is on Trump's agenda. Now, Republicans they do not want to give more money to individuals. They don't. They want to cut the stimulus money out, but they recognize, I think, and Powell's been telling them, so you need to spend more money. And so this is kind of a marriage to get something that's been a long-standing desire of Trump, a big, huge infrastructure bill, along with the, hey, we need to spend more money. And so spending the money in a way that's appeasing to the Republicans. So that's where the infrastructure bill is now. It has its best chance, right? It has its best chance of passing, since Trump became president in the current climate, since people are so willing to spend whatever infinite money is necessary. So there's a good chance that it gains some traction.
Mm-hmm. It's really interesting to think about, because I remember in 2016 and 17 when Trump was running on the infrastructure play and whatnot, when he got elected, was it Steve Bannon, I think, that was even pushing a lot of this ideal about rebuilding railroads and bridges and all that kind of stuff. Number one, it makes me think of the 1930s New Deal. Obviously, there's obvious correlations to that, spending money on jobs and infrastructure to get people back to work. I think we all can at least at some level nod our head on that. What I find fascinating is I remember in 2016 and 17 when they were talking about $1 trillion, the number seemed so outlandish. It's like, you ain't getting $1 trillion bill passed. What are you guys talking about? Now, on the backdrop of how much money they are flooding the markets with, $1 trillion seems low, which is incredible to me. I actually think they could probably get more than $1 trillion if they wanted it here, Matt. Seems like something that would be hard to push back against, even if you are cautious about spending, saying, hey, I want to rebuild, some of America. I want to rebuild the roads and the railroads and the bridges and all that kind of stuff. A lot of people would nod their head at that. Matt, is this something you support? Is this something you see as needed? What's your read on the infrastructure situation?
It's first and foremost, I know $1 trillion seems like a big number, guys, but when you break that down over 10 years of spending, you're talking about $100 billion in infrastructure every year. Just to remind people, we spend about $700 billion on our military every single year. We spend over $1 trillion on medical every single year, just on Medicare. So it's to me, and I know this might seem a little surprising coming out of a fiscal hawk like me, but I think it's light, to be honest with you. I think you're about $1 trillion light there, Trump. And this might be a little surprising because I do have some pretty staunch disagreements with the president from an economic perspective. However, the biggest disagreement I've had with the president over the last 4 years, and I'm not talking about just this Twitter account, I'm talking policy driven, right? The biggest disagreement I've had with Trump during the first 4 years of his presidency from a policy perspective is the 2017 tax plan. I completely and fundamentally disagreed with corporations needed a tax break in 2017. I still disagree with that. I thought it was absolutely insane to give corporations a tax break. You should have given consumers a much larger tax break. They would have created velocity to the money. But it wasn't just that. Trump had a choice in 17 to make. The choice was, do I push infrastructure or do I push his tax plan? He decided to push the corporate tax plan instead of the infrastructure plan. He could not get both achieved. He pushed through the tax plan first before the infrastructure plan. That was a mistake, in my opinion. I felt like the U.S. infrastructure has lagged against world competitors in other world marketplaces. You travel around the world and you see it. You see the infrastructure of Malaysia. You see the infrastructure of Singapore and Hong Kong and these amazing places. We don't have that. We have downtrodden roads, bridges, dams, and airports in the United States. We should have put a massive infrastructure plan to play in 17, should have put people to work. It would have benefited society as a whole instead of, what we did with the tax plan, just benefiting a certain portion of the national marketplace. So it's obviously something I agree with, that we need to put infrastructure spending. We need to provide jobs. And if there was ever an environment to do a massive infrastructure plan, this is that environment. You have a labor force that has been decimated over the course of the last 3 months, and everybody not named politicians know this. It's going to take years, if not a decade, to recover that labor market. And this is a labor market. If you want to stop giving people money, you might as well give them a job. If you're going to print the money, go into the debt, if you're going to increase the balance sheet, you might as well create a job, create velocity of money, and also improve your infrastructure as it goes, because that helps everybody. For those of you that are aware of the social contract and how it impacts economics, the social contract is very specific in the US, Tim. We are willing to give up hardly any of our rights. We're also, and the government is willing to provide two things. The first thing is security, military and police force. The second thing is infrastructure. Nobody disagrees with infrastructure. Nobody does. And so if there's ever been an environment to do something big, something grand, something that improves all of America, that puts ourselves on the competitive field to the rest of the world, it's not taxes. It's not increasing the balance sheet. It's not increasing the national debt for no other reason than just to give people money. It's to put those people to work. You were giving people $600 a week, every single week. People were making more money on unemployment than they were making at their job. Why would you do that? Stop doing that. I agree with the Republicans on that. Put them to work, give them a job, rebuild your national infrastructure. Who does that help? That helps all the airline companies. Who does that help? That helps the trucking industry. That helps the industrial industry. It helps the energy sector. It helps people. It helps people in general. It helps every national participant. So obviously, I support an infrastructure bill. And I also disagree with the 1 trillion. I think you need to go 2 trillion here. You have to, because it's not just physical infrastructure you're updating, guys. It is your digital infrastructure. And how important over the course of the last 5, 6, 7 years, how important is it? Have we finally woken up to understanding the importance of cybersecurity here? Has America woken up to that? Because if we have, we need to increase our digital footprint as well. So when we're talking infrastructure, it's not just roads, dams, and bridges and airports. It's not that. It's also your national digital footprint as well. So yes, that is something I support. Can he get that done in this environment? Maybe, maybe not. But I think he needs to attempt it. Yeah. And I would support any attempt. I would support, but I do think it is light in this environment. I think 1 trillion is light. I mean, my God, we've increased the balance sheet of the Fed by 3 trillion. We just announced a corporate bond buying program of 700 billion that is only going to help a select few of corporations. It's not going to help every corporation. The Fed is not going to be transparent in the bonds they're buying, but I can promise you the bonds they're buying start with Apple, Google, Facebook, Amazon. That's the corporate bonds they're going to be buying. Bank bonds, energy bonds, high dividend bonds, and they're going to be buying, the big tech bonds. That's what they're going to be buying. They're not going to be buying Hertz bonds. Let's save that for the consumers. Right? Consumers will buy Hertz. The Fed's not going to do that. So the Fed, that 700 billion bond buying program is literally only going to help a select few of sectors and a select few of industries, and only a select few of stocks within those sectors and industries. A $1 trillion national infrastructure plan in the face of all the debt we're going into that has not helped anybody, in the face of the 3 trillion the 3 trillion in additional balance sheet at the Fed, with an expectation of another 3 trillion at the Fed, approaching 10 trillion by maybe the end of the year. I mean, in that environment, 1 trillion seems extremely light here. It was just 2 years ago we were talking 2 trillion. That's what we were talking 2 years ago, and now I think it's light. I think it's light.
I think anybody looking at it from a common sense perspective would much rather have the government spending money on job creation than just giving out free handouts. Noah, I believe you would probably agree with that. Let's move past this conversation, though, and talk a little bit about the economic data. I got to tell you guys, maybe the most impressive thing in the entire day is, and I know the Fed is got to be the lead all the time, but these reports were great. They were just absolutely fantastic. Retail sales came in and just blew the number out the door. They're in terms of just looking at expectation on the forecast, what it actually was. We had retail sales, we had housing number, Matt, we had industrial production. Break this down real quick for us if you can.
Well, the only number I care about is retail sales. The other reports are very, very, it's not that they're not important reports, but in the level of, take industrial production, for example, today. Of the level of understanding industrial production, the industrial production report we get on a monthly basis, I never look at. Let's just put it like that. Your PMI numbers are a much, 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 much better indication of where industrial production is. So that's number one. When you're in NAHB, the housing market index, again, it's not a report that you should just bypass, but new home sales, existing home sales, building permits, all are much, 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 much better of an indicator of where the national housing market is. So I'm not going to look at those reports because, quite frankly, they're just one-off numbers. Retail sales, though, is a major, major, major economic report. And when we're seeing the core retail sales versus non-core, whenever you see core versus non-core, they're always, eliminating something that they're looking at in the report. So in the core retails, you exclude automobiles. The same way in the core CPI report, you exclude, energy and food-based groups, right? So in core, you always exclude something that could be very, very prone to quick volatility shifts. Like in your core PMI report, you exclude airplanes, right? Because they can be volatile in the short term, which means they can increase dramatically or decrease dramatically. So core came in at 12.4%. Non-core, which comes in with automobiles, came in at 17.7%. Now, to give that number a little bit of historical connotation, and I know this is, absolutely, crazy to see what we've seen economically, but we've never seen a number like this, guys. We never have. Now, again, we've never seen a negative 15 number we saw last month anyway. So it goes to, give a lot of credence and credibility to Mark's earlier argument that coming off the lows, it's a little different, right? It's a little different. And the president's going to be on Twitter today touting, how he's the one that's, improved the economy and he's the only one and all that. And, give credit where credit's due. A report came in, it was good. Let him, pound the chest, even if he had very little to do with it. So in terms of this, though, it's kind of like a stock, guys. When a stock gets beat up so bad, those percentage movements you're coming off the low are exasperated, right? When a stock goes from 90 to 10 and then it moves 10% in a day, everybody in the market's like, oh, did you see XYZ company? It's up 10%. Well, that's a vastly different number than going up 10% when you're a $100 stock than going up 10% after you're down 90%. Can we agree with that?
It's easier to make a comeback. There's no doubt.
Yeah. The recovery we saw isn't surprising in retail sales. It's not. The number is a little surprising, though. That's a big number, 17.7 on retail. That's a historic number, guys. So give credit where credit's due. Can it maintain? Obviously not. If you want to see an economy get back to where it is, this is the type of numbers you see. It's not massive 15% down, upwards of 17% the next month. So, good number, supports the economic recovery in the short term, no doubt about that. But let's see a trend develop here, not just a one-off number.
Yeah, let's move on to through commodities next as we work through our top-down analysis in the market. And welcome out, everybody, as always. Tackle Trading's Halftime Report. We love doing this with Team Tackle out there. If you're a veteran, you know our hashtag. Pop it in the chat for me right now. Hashtag Team Tackle. It's a great way to promote our community. And if you're new, welcome. Make sure you click subscribe, click the bell, come back and join us each and every day. Marky, crude light here is kind of hesitating, obviously, in this little hesitation pattern, up near about $38 per barrel right now on the WTI contract. What's your read on crude oil, Mark? What are you watching fundamentally from a supply and demand perspective, as well as charts?
I'd be really surprised if we don't see sideways price action for a little while. Maybe it only lasts a couple weeks, maybe it lasts longer. But gasoline sales, part of that report, were up 13%, which is nice. People are getting out, traveling a little bit more. But, it's just a mixed bag. I mean, there's nothing that scares me, to sum up, about oil right now. And there's nothing that I'm euphoric about oil right now. So until we see something change where, people do get back to driving like they used to, they do get back, the supply side's done about all it can. My whole argument for months is that they'll cut supply, it will create a bottom, and it performed even better than I thought. But really, to take that next leg up from here, it's all about demand. Supply's cut, they've cut dramatically. Now consumers, flights, all of those uses, industrial production, all of the uses in oil have to pick up here for oil to take that next leg up to get back in that 50 range, that high 40 range.
Gold next, if we can here. Let's have Mark break down these commodities one at a time. Obviously, Mark, you do the commodity report over the weekend. Always look forward to your analysis on that. So let's get some analysis on the metals market. Little hesitation candle here up near resistance. With everything the Fed's been doing the last week, and I'll get Matt's take on this as well, doesn't that just solidify, Matt's argument for the last 6 months on gold and everything that we've been looking at, thinking about, talking about with patience? Mark, what's your read on gold right now?
I mean, let me steal a line from Matt. Wake me up when it breaks the consolidation. We've been consolidating for a long time now, a long time in gold. And don't try to guess. This is the one thing I teach. And commodities can trade sideways for a long period of time. This is kind of an itty bitty consolidation, but even in broader consolidation patterns, commodities can just trade there for months and months and months at a time. So this isn't exactly unusual in the world of commodities. Until we get something that breaks that consolidations, some true something, a catalyst on any level, just assume the consolidation pattern is going to hold until it doesn't, and then you can reevaluate.
Yeah, and Noah, I'm going to have you run screens here for a minute, if you can. Let's make that little handoff. Matt, from a fundamental perspective, just on gold, there's a couple things that I'm very impressed with. Number one, obviously, it's been holding up in the face of markets rallying. Price appreciation in the metals market, just incredible if you think about it over the course of several years. But obviously, that consolidation's got it stuck. But guys, in the face of a stock market in the 50-day rally, the biggest 50-day rally in all time, wouldn't you think that maybe gold could have taken a pullback here, but it's been very, very resilient? Wake me up when the consolidation breaks. I agree with that, Mark, but it doesn't mean I'm coming off my positions, though. Maddie, go ahead.
No, doesn't that give you more belief in the gold ownership position, though?
It does for me.
Only time ever since the Fed lost its mind, in terms of, the balance sheet and whatnot, the only time gold came down, guys, was when you were having margin calls on stock positions. That's the only time gold is sold off aggressively in this environment, right? In the face of the largest movement that we've ever seen in the S&P 500 from a 50-day perspective, in that 50 days, gold stagnated. Gold stagnated. It wasn't that the investors in gold like, oh no, let's go buy stock. No, they just said, okay, I'm comfortable with my gold position. But to me, when you're looking at what the Fed has done collectively from 2009 till today, but specifically September until today. So let's take a quick peek at the weekly chart here. If you're looking at it from just September on, right here on, what has gold done? In the face of everything the Fed has done, it's up, 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 up. So gold's never going to drive like a stock. It's never going to be your high flyer growth type company. Think about gold as, the Walmarts and the Coca-Colas and the Pfizers, just old, boring stuff here. It's fascinating though to see gold hold up in the face of all the bullish momentum. But the reality is this, guys. The same monetary and economic policies that we're putting out to support the stock market are the same policies that also support gold ownership. And so gold and the stock market can both run here. Okay. If the Fed is going to do everything they can to push asset prices up, i.e. increase the money supply rate, well, as the money supply rate goes up, gold goes up because it's an inflationary protection mechanism. And so both can be true towards stocks and gold. Both could be an investment here. Now, for me, I'd prefer the gold investment over any stock investment right now, because it's like I heard Noah on the podcast yesterday. He said, you know what? I like to sleep at night. I've heard Mark say this how many times, when, anybody is even remotely poked fun a little bit, just in playfulness of, hey, Mark, why don't you buy equity instead of, selling naked puts? And Mark's like, I like to sleep at night. Well, that's the same thing with gold. There's obviously a room in a portfolio for getting those high growth PE ratio stocks to take advantage of the euphoria of the market. No doubt about that. There's an area in your portfolio that you should have allocated to aggressive trading right now, that you're willing to take on the risk for the potential high return. Absolutely 100%. But there's also an area of your portfolio where you park in gold so that you can sleep well at night, knowing two things: knowing that you're protecting against the ultimate risk of the Fed, i.e. hyperinflation, and number two, you're also protecting against economic upheaval in massive downward movements in the marketplace, because gold is a safe haven as well. The only question that should be asked here is what percentage of the portfolio, kind of like we talked about on the halftime report yesterday, when my nephew texted me, what percentage of his portfolio, he's 20 years old, what percentage of his portfolio should he allocate to the crypto market, right? That's the same question that we as investors and tackle trading need to ask ourselves. What position size should we look for? What percentage of our portfolio should we allocate to more conservative nature of the market, i.e. gold, in that capacity? And so it's just, to me, it's just a matter of what percentage and where are you looking to add to that position versus where are you looking to come off that position. And everything fundamental leads to gold appreciating in price. Everything I'm seeing technically in this stagnation we've seen over the last 2 months in gold leads me to further believe in gold, because in the face of just markets going up, gold maintained. So again, I maintain my technical premise of you're adding to that position above 1760. You're removing a little bit of the risk underneath 1680. Between 1680 and 1760, you're just hanging out, just doing nothing, just appreciating that an area of your portfolio isn't doing crazy things on a daily basis.
I love it. I love the analysis there, as always. Let's do a quick little handoff here, Matt, if you can. I'm going to have Noah run charts for all the stock talk segment, as well as just the last one on the dollar. Noah, as always, appreciate you coming in here, and go ahead and bring your screen up when you can. One last one real quick, the US dollar, and I'm going to bring Cody back for just a second here. Cody, as always, I like to get you in here. You're the Forex kid. Is that tagline going to stick, Cody? The Forex kid?
I'm not a huge fan of that one, but we'll see.
All right. We'll see what happens there.
Cody's a 79-year-old man in a 28-year-old body.
The oldest young man.
I was literally just about to say, Cody sees himself as a 75. You said 79. I was going to say 75-year-old man. But...
he identifies as a boomer, so it's all good.
How about the Oracle of Forex, Cody?
I'll take it.
Something. Anyway, Cody, this development on this bullish or bearish retracement is now several candles in. We had the two candles, then the one red candle, kind of gave us a little hesitation there. A lot of the setups you were watching, I'm sure you're still watching for them, Cody. What are you reading in the Forex markets right now?
Absolutely. So a lot of what I taught over the weekend actually worked for the quick play, not necessarily the longer term play. So I taught in that Forex report, and if you haven't watched it, I definitely recommend going out there and watching it. Is using a doji pattern to trigger in, move your stop after the stocks move the next day, to where you're locking in a short amount of profit, and if it keeps running, then you have that greater potential. So that's the basic lesson I taught. And what we ended up having happen today was it came down and hit that stop loss and locked in the quick profits versus the longer profits. So because of things that Powell said, because of what the Japanese bank did, we saw a lot of rotation in money over the past day. From what looked like it was going to be those quick retracement to continuations, they are pandering and just going sideways now. So we're going to have to see what happens over the rest of the week based on everything that was said. There needs time to process in the market, see how they react, to see what those currencies actually do. So on this, I'm not necessarily liking as much, but obviously if it were to break below yesterday's close, then the obvious point is that low for the US dollar. Some of the cross pairs, again, they're all the same. The ones I pointed out yesterday on the Aussie, they could still work It's just a matter of we now have to get above yesterday's close before we can then trigger it into those, versus where if you're already in and you have your stop below the pivot, you should still be in this trade. So we're in a wait and see environment to see if we can trigger into another trade, not necessarily looking to jump or force any trade to happen now. I'm gonna wait for it to set up, wait for it to trigger in, and then manage it accordingly.
You know, and Cody, I got to admit something. I didn't get a chance to watch the video on your report, but did you go through the dollar CAD crosspair? Because I like that setup a lot. Bring up USD CAD, Noah, if you can. I know it's been a couple of.
You mean the one that Matt and I were pointing out to you 2 weeks ago?
Yeah. Hey, listen, 2 weeks ago, I was off the Forex train. Now I'm seeing patterns develop. It's like any trader, right? The charts are grabbing my attention a little bit more.
Are you publicly acknowledging the fact that you don't want to eliminate the Forex report any longer? Are
Listen,
you flip-flopping?
I am. With new knowledge and new information, every human being should be willing to change their opinion. I don't like the term flip-flopping there.
So while it was boring, you wanted to eliminate it.
Flip-flop, though. I mean, yeah, people flip-flop over decades. Like, opinions change. What I thought in the 90s is not the exact same as I'm thinking in 2020. But I mean, to flip-flop in a 2-week time frame, that is amazing. You would make Romney proud right now.
By the way, that's 2020 these days. Social media and information and news and even science seems to flip-flop in 2020.
Change my mind.
Listen, I pride myself on consistency, right? So you flip-flopped, you own that.
I pride myself on consistency. I consistently flip-flop from time to time. That's just, we're all running for office now, apparently.
Yeah. Hey, if you eliminate anything when you get bored of it, Bitcoin would have been gone a long time ago.
Dude, I've never been bored of crypto markets. It's stuck in a range. Although, by the way, if you're out there and you're watching Bitcoin, keep watching that range. Same thing on any consolidation. One thing a technician loves is that time consolidation, because it can create some real clear support and resistance zones. Guys, top-down analysis. Let's be done with that now. Let's go on to
argument on Bitcoin right now that you could on gold, and I hate saying that.
Yeah, it's very similar in terms of just the price action. You know, obviously.
Yes, I'm talking price action, but also in the face of, probably Bitcoin coming down, it's held up.
Yeah, it has. It's been resilient.
I'm not making the inflationary. That's not the argument I'm making on Bitcoin. No, I'm talking technically in the face of what was seen from a stock. You most likely would see Bitcoin come down, but it didn't. And the longer this consolidates under 10,000, the more I like it above 10,000.
Mm-hmm. Me too. And Bitcoin still on your radar?
Oh listen, if I can find a cheap way to sell puts, to manage, to sell calls, if GBTC ever gets options on it, I'm really interested. I have a hard time trading things that I can't theta, right? So,
well, I've been waiting for an ETF that you can do that ever since 2015, since the Winklevoss twins came out with their original plan. So if that's what you're waiting for, you might be waiting for a lot longer.
Fortunately, I have a lot of other things, but I mean, there's just so many things you can do to help maximize your position. And yeah, it's just, I don't like trading things I don't have my tools on.
Sure. No, and I get that. I don't think they're going to add options. Regulatory, they've been pushing back against that for a long time. You don't need the leverage in this product if you're playing Delta, but obviously you like that theta stuff. I get you completely. Guys, let's make a transition here. Let's talk about individual companies. Noah, can you bring up tradingjustice.com? One thing I like to do whenever we do make a transition is to promote at least something. And yesterday, here's a perfect time to have Noah actually bringing the site up. Because Noah, you were our guest on the podcast. You and I sat down. We had a conversation. We had a fun time with that. I thoroughly enjoyed it. Noah, kind of explain what we talked about on that podcast yesterday that just got released last night.
Well, we spent a lot of time talking about the technicals, what we like to see in the bullish retracement type patterns, because they had a lot of them yesterday. And we talked a little bit more about that disconnect between the technicals and the fundamentals of the market and just, where our concerns lied. But it was a fun conversation. I thoroughly enjoyed it as well. And it's just good to kind of be able to talk those things out, because I think everybody's struggling. Well, not everybody. Most people out there are probably struggling with the same kind of concept, is that hold your nose and buy, don't fight the Fed. Charts are going up, even though we do see some disconnect between what we see economically and fundamentally. So it was a good conversation to have, and I think it would be beneficial to everybody.
You know, and Matt, we brought back Clown of the Week, which I got to say, I just had a blast with. I was laughing even last night thinking about our conversation. By the way, it was fun. Welcome back, Clown of the Week. I'm sure we'll do more.
Well, and we're not going to spoil it, but there was a certain individual who has done some radical things, and then lies to the American public every single day. That got Clown of the Week, and so we'll leave that there.
Well, that basically describes 98% of all politicians. these
I was
days,
thinking
man.
Roger Goodell. Is that
I was
Roger?
gonna- well, I was like,
Yes.
Roger Goodell. Okay.
Roger
Listen,
lied.
I specifically described it as a way to let your mind go wherever you personally wanted to. So obviously Mark's thinking about football right now, and fantasy is coming back, and Tim's thinking about politicians. But that's you guys will see where I'm going. Listen to the podcast.
Yeah,
he was a very deserving, and Tim, I think you nailed it on the head. He was, it maybe was not one moment in time. This is a lifetime achievement award for Clown of the Week this week. So hopefully you guys enjoyed the podcast and the discussion we had on Clown of the Week.
There was a pent up demand for the votes for this one. There's no question about it.
I wasn't going to lose.
Give it a listen, guys.
Tim, I was going to filibuster until I had beaten you guys into submission.
You needed it.
You
You had to have it. Make sure you listen to the podcast. Follow it on anywhere you can find podcasts. You get a lot of value out of it. We have a lot of fun with it. And this one was particularly good, in my opinion. Noah, it was a great conversation. Back to the markets.
I just want to say, I hear Noah all the time. I just enjoyed listening to Noah yesterday in free form, through his mind. Yeah.
A dangerous place to be, quite frankly, but we try to keep it light.
Yeah, it is a dangerous place to be, Noah. I would love to be able to tap into your brain and see how nonlinear it is at times, because I know that you chase squirrels, right?
Yep, it's what I do professionally and as a hobby.
For sure.
So I go down rabbit holes too.
That's right. All right, guys, we're going to be talking stocks here for the next few minutes, and that's what we do every day here on the Halftime Show. We start with the big picture market skyline, then we transition into individual company news and stock talk. There's many I want to unpack here a little bit. Bring up Apple Computer if you can. Couple of news points on Apple Computer. The European Union came out and said that they're looking into an antitrust probe. It seems like it does not matter what happens across markets right now, guys, in these big tech names, even when they get AGs looking into them, Mark, or the European Union, or, a country that's saying, hey, we're going to look at Google or maybe give them taxes. The market doesn't seem to care at all, even in the face of what would the perception be of negative news. On the positive news front, Citigroup actually raised Apple's price target from about $320 to $400 per share. Mark, Apple's a juggernaut. What's your read on this company? I mean, that trend is just beautiful. We're approaching resistance. What's your take on this stock?
I like Microsoft better. I mean, because and I say that glibly, but okay, unless you're just putting all of your money into tech in these big names, you got to choose, right? I can't invest all my money in just all big tech. At least I don't, because I like diversification. And so it's always an evaluation and a breakdown between the big names, right? Google, Facebook, Apple, Microsoft. I like having something going in one of them, maybe two of them at all times. And I can't, once again, great company. Apple will be around for our whole life, likely succeeding our whole life. Apple's share price in 5 years undoubtedly will be much higher. I just can't get over they just don't feel like the best of the breed in this particular COVID-19, where consumers are going to have a lot less money. Those consumers are going to have, a lot of those unemployed are not going to have those $600. Unemployment's going to remain high. And so a consumer good company, which Apple really is, I just like other tech names better in that environment.
The trust and investor sentiment around this company, though, is as high as it's ever been. Obviously, people are willing to hold this stock no matter what. It's hard to fight that trend. I can't argue with what you just said there. But
trading, I want to go bearish, and in 5 years, Apple's going to be like everything is in this market, right? Barring some economic collapse. It's just like you're always breaking it down one versus another, though, because you can't invest in everything. I just like Microsoft the best of that particular group.
By the way, you mentioned some of the FANG names. Look at Facebook real quick here, Noah. We'll just flash you a little bit. Approaching resistance, about to break out. Give me Amazon if you can. No news on Facebook today, but just relative strength in a lot of these names. Amazon, a little bullish retracement, little hesitation candle there, but a beautiful uptrend. Give me Netflix if you can. In Netflix, still kind of range bound, actually needs a little bit more work there from a chart perspective. Google and then Microsoft. Google kind of hesitating, needs to break out, and you got that old resistance there. And Microsoft's just been clean and good. I get what you were saying, why the reasons why you would prefer it. But I got to tell you, the Facebook breakout and the Apple uptrend, the consistency look like the strongest charts to me. Noah, what do you think out of all those different ones?
We talked about Facebook in the lounge this morning, which I still like that high base. It's got a pretty clean trigger up there above that 241 ballpark.
Mm-hmm.
And so I really like that setup. I really like Microsoft's chart as well. I mean, I actually thought I've been watching both Microsoft and Apple. Those are kind of my stocks of the week last week as we were talking about it. I like those both. I don't like was the Amazon chart? No, Google's chart. It was the Google chart. I didn't like the Google setup quite as much. Just because it recently broke the low. I didn't like that it broke the low, so I want to see it retest out there. Whereas like the Microsoft or the Apple's coming off of the higher low. I like the higher low on those for the run.
Mm-hmm, mm-hmm. There is some take your pick in there. Obviously, there's several setups I think that are developing. Next one, T-Mobile. My wife came down last night, and I was listening to a podcast and just kind of hanging out just before bed, getting ready for bed and whatnot. And she said, "Did you hear that T-Mobile lost all their service yet today?" And, her dad works in the cell phone industry. That's his career. He's been now building cell phone stores and working. He used to work for T-Mobile 10, 15 years ago before the crash. And that's his profession has been in cell phone service. And she's like, yeah, they lost service across many parts of the country. In fact, I looked it up online. T-Mobile, they dropped a lot of customers for like the entire day yesterday. And she said, do you think that'll affect the stock price? And I'm like, no, I don't. Because one day disruptions in service as consumers, we've all just come accustomed to that. And here we are actually just still pressing the high.
See, I always love when I see algos buy it almost to the penny off the rising 20-day.
Mm-hmm.
Algos don't care about that news story. It came down to the 20.
Algos didn't lose their cell service. No, algos are cool.
Yeah. And here's the thing, people aren't going to cancel their cell phone just because they lose one day of disruption, obviously. I mean, I think a lot of customers will be like, okay, I understand that. They're going to be frustrated for a little bit, but as long as it comes back, they'll keep paying the bills. T-Mobile looking like a beautiful uptrend there. I thought that was interesting. Ford, did you guys ever own a Mustang?
Oh, I dreamt of owning one as a kid.
Noah, have you seen the new 2021 Mustang models?
I have not, but I have seen from Ford. What I am interested in is those new Broncos.
I'm going to drop a link in the Zoom chat. I want you to grab it real quick because I got to show you this. I've never had a Mustang in my life. I've always been absolutely enamored with Ford Mustangs, though. I've loved them when people bring them by. I mean, I'm not a car guy, but I even
I'm looking at a 2020 Ford Mustang, and it kind of has this sleek Mustang BMW feel. Listen, if I was a young man, I'd be interested in that car. Like, if I was in my 20s. I mean, it's kind of cool.
Mm-hmm.
Now I'm too old to be driving that.
We're a Corvette family over here. We don't do that Mustang garbage.
T-Bird and Vet, the old 80s fights between the cars. I thought it looked like a gorgeous car. I'm like, Ford is doing some good things. I'm always been a Ford fan myself personally. And yet the news is always about Tesla and getting those cars out there.
Those old Mustangs, though, those classic ones, those were just cool cars. They really were.
Yeah. I think it's one of the great American cars, and I thought it was really cool looking. I don't know exactly what it's going to do for sales or hype or whatnot, but bang, bring back the Mustang, one of the great American brands, Ford Mustang. Very interesting.
I say bring back that Bronco, baby.
Dude, that's you. You love that because you're a Utah kid that likes to go to the camping up in the mountains, right?
Oh, yeah, it's cool. You can drive fast in a Mustang, but you can't go over things.
Yeah. If you're out there watching right now, would you buy a Ford Mustang? Do you think it's an interesting looking car? Does it grab your attention? Does it grab your interest? I know when we talk Tesla, so many people out there were interested in that new truck and whatnot. I see that car. I'm much more attracted to that myself, Mark. I don't know about you, than one of those cyber trucks. Cody?
So I think one of the coolest videos I saw was someone took not this model, but the most recent Mustang, the Cobra version with all the souped up stuff, and they tore its body apart and they made it look, and they rebuilt a body on top of it as a 69 Mustang. I gotta find the video. It's one of the coolest things. So it's 69 Mustang, but with all the new engine on the inside. I gotta find it. I'll
Dude, if you find it, drop it on Twitter. What's your Twitter handle for anybody who's not following you yet?
It is CMackey14.
CMackey14 on Twitter. If you find that, put it on Twitter. I would love to take a look at it. Just interesting news, in my opinion. I thought it was a cool looking car. Walmart, if we can here next, back on stock analysis. This is an interesting one from a story perspective. There's a story in Arkansas, Noah, for Walmart. They're going to test this out. Drop it on Twitter. What's your Twitter handle for anybody who's not? And Cody, that might be. Am I hearing your audio?
Yep, sorry.
No, it's okay. A little meta when you hear your own voice. There's no doubt. But Walmart is moving in this one store to 100% self-checkout only. There will be no checkers. There's no teller mark. You have customer service for returns and things like that. You got all of the other regular stuff in Walmart. You have associates that are there to help you and greet you, but they're like, we don't need a checkout. We don't need a teller there to actually run your stuff. You're going to do it as a human. I think we're going to see more stories like this. They're testing it to see how it works. Noah, would you go to a store that's only self-checkout?
Yeah, but I really try hard to shop locally. I do occasionally find myself in a Walmart or a bigger box store. But I kind of, when I have the choice to go to a self-checkout or to a checker, I go to the checker just because I kind of want them to have a job. So that's kind of how I roll. But I think the masses will like the convenience. And I also kind of like that, Amazon Whole Foods model where you don't even have to go through the checkout. You just pick up your stuff and walk out. Have you seen that?
Well, I was even going to bring that up next because that's how Mark shops at Walmart. Mark, forget the self-checkout. You just do curbside pickup, right? Yeah. I mean, they're going to eliminate a lot of the traditional jobs in retail and customer service that we might have become accustomed to. I got to tell you, I'm with you, Noah. I'm obviously a supporter of jobs and all that kind of stuff. But I don't need a kid at McDonald's taking my credit card. I can do a little kiosk. I can punch in the food order and pick it up. I have no problem with that. I've used self-checkout for a long time. Now, when I go to the grocery store, there's a lot of times I want to talk to the teller and be social and whatnot. But I can see this becoming a bigger and bigger trend. I remember when self-checkout came in and people almost revolted. They're like, I'm not cashing out my own stuff.
What, do I work for do I get benefits too if I'm now working for the company? Come on.
Right. We all heard the complaints, but people adjust. They will. You're going to see more automation over time. A disturbing story. In fact, I'll just bring it up real quick. Did you guys see the story on eBay?
No, not at all.
EBAY. They had 6 employees indicted in the state of Massachusetts because somebody who writes a newsletter was criticizing eBay. And these employees went through a concerted effort to do cyber attacks on this individual and their newsletter for years, I guess. They invaded their privacy, all this kind of stuff. And eBay obviously fired them, distanced themselves from it. But Matt brought up a point way earlier. Are we aware of cybersecurity today in 2020? I even went in and did some password resets here today.
You're telling me that the employees just independently outside of corporate knowledge just said, hey, they're attacking our company. We're going to start a sophisticated cyber attack.
Somebody had to know about it at some managerial level, I'm sure, Mark. These 6 individuals were indicted just this morning, though, in a Massachusetts court, and we'll get more information on the story. But it just, obviously, whenever you hear that somebody was being attacked because they put out an opinion, somebody was writing critical things about the way eBay delivered products, and the chart doesn't care. It's obviously not affecting the stock price and whatnot. Just another reminder, you got to be careful out there online. Obviously, people, there are bad actors in this world, in my opinion, but Hey, if you're just looking at eBay alone, those plays don't work for them. That's an interesting pullback into the moving average. Kind of gave me the willies, guys. I did not like that story. It just kind of creeped me out a little bit. Delta Airlines next, if we can. They are reopening flights to China. Mark, anecdotal evidence across the airlines that they're picking up, demand and all this kind of stuff. One of the major reopening themes in this economy will be airlines. You interested in airlines here, Marky?
No,
Not at all.
no. I mean, once again, trading is totally different. Like when you trade, it doesn't matter what you think. I get a nice setup on airlines. I get a nice setup on Apple. I get a nice setup on anything. Those beautiful technical patterns, trade it, right? That's what we do. That's what we teach at Tackle Trading. But like airlines still, you can pick up from an investing standpoint, if they get dirt cheap, sure. But airlines burn a lot of cash every day, a lot. And if airline travel is significantly altered by any modest percentage, it still seems expensive to me from a long-term point of view. So, airlines are going to come back in the sense that are people going to travel? Yeah, but a lot of businesses have changed the way they do business. A lot of conventions have been canceled. A lot of the big, huge, it might be many, many, many years before we even come close to that. And at the rate they burn cash, I mean, American Airlines balance sheet is a disaster right now. Absolute disaster. So like, this isn't Microsoft. This isn't, AMD. This isn't a lot of companies where you can get a really good feel for what their future holds, no matter what the environment is. Airlines, it seems like a lot of guesswork right now. So if I'm going to take a guess on an investment, it's got to be cheap. But if I get a good trade setup, if I get a nice consolidation pattern, sure, I'll trade anything.
Noah, from a trading perspective only, I understand that the concern from the investor perspective, but is the reward to risk there on some of these airline charts for you? Because I'm interested trading wise myself, just some of these reversal patterns. Noah, what about you?
Well, I looked at a lot of those pullbacks and they had a lot of range. There's a pro and con to this type of a setup that I think it lends itself really well to reward to risk ratio. And really it's one of those things where you just look at the last resistance, you look at the last support, and you look at the distance between the two, and you figure out how much would it cost you to buy with that confirmation. So if you caught that on early confirmation, you got that 2-to-1 reward to risk ratio. So that's always nice. The big con with it is that it was a really hard drop down into support. So there's a lot of downward momentum coming into that. So you expect a big bounce or a little bounce. And, thus far with that red candle coming in today, it kind of messes up whatever reward to risk ratio you have. But one of the things we're going to talk about in the coaches show tonight is exactly what you see on these airline charts right here. That's a pullback that gapped up, Tim. And we saw a ton of these this week where you had really pretty pullbacks, but that candle, that gapped up to the open and it's filled the gap. And so if you were still interested in placing a trade on a pullback that gapped up like that, we're going to be talking about that tonight in detail.
Yeah, and I'm fascinated this because when I woke up this morning and I looked at the gap up in the overnight, and I went and looked at American Airlines and Delta and MGM, and I'm like, okay. Because like when I get that smooth opening, right, you break resistance, you clear the candle, it's easy. We know how to do that from, decades of trading. It's what we teach. How do you play the gap up, And I'm fascinated, and I'll be a student fly on the wall in your show tonight, Noah, because I'm really curious on you and Coach Greg Holmes' take on when you have an entry point and it gaps above that, because it's not uncommon at all. How do you play? Where do you put your entry point? How do you play that? And I'm really, really interested in what you guys have to say tonight in the coaches show.
It'll be a lot of fun. Make sure you're there.
Yeah, I love that as well. And obviously that intraday chart is going to play a role in how you kind of map all those things out. Looking forward to it. So you and Greg tonight, is that right?
Oh, yeah. Me and the friendly Canadian. I'll see if I can get him to say a curse word. not
I doubt
likely.
it. I doubt it. Not in public. There's no way he would ever do that. But let's kind of transition into our last section here. We're going to go into our coach's corner and get ideas, final thoughts. Kind of get some perspective from each of the coaches that are on the panel here today. The coach's corner is one of my favorite sections. Because you can kind of just whatever you're interested in as a coach, you can bring it up if it's a stock chart or whatever it might be. Couple things I do want to promote here as we're transitioning into our last transitions. Number one is our YouTube channel. Coach Cody, what are we, like 100 away, I think, from that 9K mark we've been trying to get?
We're 100 away. So
Yeah.
I think it's 102 right now. But guys, seriously, if you have a friend, a family member, they know you're trading, they're interested in themselves, and they're always asking you advice, and you're giving them, hey, well, I got this from this report, or hey, I'm looking at this because I learned from you. Well, why don't you tell them to go ahead and just subscribe to our channel? That way they can get the knowledge straight from us. And obviously, get them to read our blogs, get them to sign up for the daily email, and just word of mouth is the way that we're really growing this community. It's so much more powerful than just blanket facing ads all over the place. So guys, Team Tackle out there, if you have someone who's always turning to you for advice, just hey, let them know, hey, go subscribe over there and you can get some of the same information. We'd love to welcome them to any new trader that wants to actually learn financial education. We're always here. Team Tackle knows that.
Yeah, for sure. And these little markers, I mean, I got to tell you guys, I mean, just from a personal perspective, what we're doing here, kind of growing our company, growing our community, helping traders out there, being a part of Team Tackle as coaches, as students, as all of it. They're exciting for us. We love them, so we appreciate your support. There's no question about it. We're here for you. If you need anything, let us know, especially, if you're a pro member, team at tackletrading.com is a great way to get a hold of us. So get the word out there. But let's do final thoughts here. Noah, what are you paying attention to? What are you going to be watching? What are you setting up for? What's on your mind there, sir?
Well, I've had a couple stocks on my radar. Peloton from our scouting report this week, I still like. It's right there, pressing that breakout. You could probably enter on confirmation here. Really good options report this week. So I really like that one. And then one that was called to my attention for a different reason was Square. I like the Square breakout. I'll give Cody credit for that one because, give me a little heads up on that breaking out.
You're welcome.
Cody's like, I got stopped out. No, but it's a good looking breakout. I like the setup. I like that. Nice. If it can close above resistance, I think you can trade it bar by bar.
Mm-hmm. Yeah, beautiful. That is a beautiful breakout. Cody, what about you, young man? What are you going to be paying attention to? What are you watching? What's on your mind?
Well, Noah did just steal my Square because that is one that I've been watching. I got into this one on Thursday when it peaked its head above that breakout point on Thursday. But then, of course, we know what happened Friday and then Monday. But yesterday, that huge run up bearish engulfing candle, I love this. And then the follow through today to redo that breakout. I really love this Square chart. Also, I'm watching a lot of the retracements I pointed out on the Forex report. They're not necessarily dead yet. Like I said, we just got to see if they play out. But some really quick in and out entries in the Forex market going on right now, guys. So leave a message on the Forex report if you want some help on entries or something like that, or you can always email me, Cody@tackletrading.com, and I'd love to help out my Forex traders.
Love it. Marky, you next. What's on your mind? It's always a question I love asking Mark, but then I'm very curious to what his answer is going to be. Mark, what are you paying attention to? What are you focused on?
On a day like today, there's not a lot I do because, with the VIX, although it's about even from the day, I got spoiled last week on those on that volatility spike, right? And I have volatility hangover right now because when you have a huge volatility spike, your naked put premiums get so high and you're covered. I mean, everything gets high and there become things that maybe on sale.
Where are you at on your little naked put contest that you and I had?
Oh, I'm at, I think, 13.
And you needed to get to 15?
As long as the market doesn't, no, it was 12. I beat it, but Yeah, well, I mean, to be fair, let's call it what it is. In a Fed-fueled market where you're very selective, where you sell naked puts, it's not hard for them to expire worthless when you're patient, right?
Mm-hmm.
You know, the Fed has my back. But, you know, on those volatility spike days where you have this huge volatility and then it eases up again, you know, just patient wait. You know, market will go down another day. It doesn't mean there will be a bear market, but it could create some nice opportunities when it does. Other than that, I've been pretty much formulating have one distressed industry delta play and one tech delta play. And so rotating, finding what the best play. That square setup does look pretty nice. That's a nice technical pattern. Just figuring out how to play it now. But that's one of the better technical patterns on the charts right now.
You know, and I do like that mindset right there. The difference between the distressed reversal pullback, you know, and Noah, one that I'm paying attention to, I'll go next here, like an Exxon Mobil, you know, and I know these are trading setups and whatnot, reversal characteristics, old resistance, new support. You came back and found a pivot point, intraday confirmation. You got to get clear confirmation, all that stuff you need to know on how to trade these, or even a Carnival Cruise Line, CCL, some of these distressed areas coming off the bottom. I know that one's got earnings here in a bit, but it's a good example of what we're looking at against some of those rallies like on Square or Facebook. Like, to me, the Facebook setup is just beautiful above 241. You know, if you and you might even be able to trigger above 240. I'd have to break that down into an intraday. But I like that mindset, Mark, having some of the distressed reversals on your watch list, as well as some of the momentum plays on your watch list. You don't want to just play one or the other, because if there's one thing that I have been seeing in this market day by day, the movers are not always the same. One day it's distressed, one day it's momentum, one day it's reopening, one day it's the coronavirus plays. And Mark, there's these little pockets of stocks that all tend to move together. And so you kind of have to have exposure to different areas of what they're doing, right? Lily did have news today, Guitar Flip. Guitar Flip asked in the chat, news on Lily. Actually, they had positive news around their breast cancer treatment. I didn't read the study on it, but I read the headline on that. And obviously, whenever you have a company that's dealing with, you know, medicine or whatever it might be, cancer treatments, new trials, it can have these random spikes. And Lily about to break out there on that news. Yeah. Other ones I'm paying attention to, take a look at some from the reports over the weekend, Noah. The stock and options report were fantastic. If you have not gone through them yet, become a pro member, go and review over the weekend. There's a bunch of great watch lists. Look at MGM.
This is a pretty setup.
I like it. I know red candle there because we've given back some of the intraday gains, but in general, I like the overall pattern developing here. Got to go down to an intraday chart to find it. Look at CLR. Same. So you got some of these reversals. RCL, if you're looking for cruise lines, it wouldn't be Carnival, it'd be Royal because there's no earnings on that. And then even a PayPal, like look at PayPal, PYPL. Just a beautiful breakout up there at the high. Now, Mark, PayPal is not a great swing trade, in my opinion. It's a better position style trade, but
yeah, I know PayPal. It's just choppy. It's just like when you look at the previous breakouts, and this goes back years with PayPal. You know, we're so spoiled as traders sometimes, where you have breakouts and they run, and then they run 2-3 days, and PayPal is more of a meander. Like, you know, it and Microsoft have a lot of similar characteristics, is that when it starts to break out, it's usually not as clean. It's just, it just slowly meanders, and you just got to know the personality of the stock.
Yeah, I agree. And, you know, whether you play it swing or position style, that's going to come down to trading plan and whatnot.
Basically, if you have a tight stop on PayPal, Microsoft types, you can get stopped out a lot is what it means. So just be aware of that. So, you know, if you're going to do it, it almost requires a little bit looser stop than some individuals might like to play the longer trend. So
I love it. I love it. And then a couple that were not on reports that I'm finding interesting. I had mentioned Exxon Mobil once as well, but then I found a few in industrials here. Look at International Paper, if you can, Noah, IP. Little reversal characteristics, or a CHRW, trucking company and shipping. reversal characteristics. I'm going to be watching these industrial plays develop this week, especially on the backs of that infrastructure news. I do think industrial names might grab some attention. We looked at X earlier, US Steel, kind of gapping out into some resistance. Interesting reversal characteristics on that one as well. And then one last one for me here, Noah, is going to be Twitter. Still like that general trend. And I got to give at least one bear grabbing my attention. I'm still watching CME for a breakdown. I do not want to miss this breakdown. If it does occur and you get confirmation, by a close of the candlestick, I think there's a lot of air.
Out of curiosity, we just pull up CAT's chart. CME and CAT sometimes have similar patterns. Not this time, though.
No, cat gapping out on that.
Well, I mean, there's a synchronization there, Mark. It's just there's like, if you look at the general cycle, like it was down, up, down, like it actually had an engulfing range. They're actually really similar. It actually did the same.
Just the
down,
extremes,
up, down.
the
Just an extreme version of it.
Extreme version.
Yep.
Yeah. I love Hero's comment here. He says, hi, Tackle Trading, Team Tackle. I put on the Square trade from the weekend reports. That alone is showing more profit than the cost of a pro subscription. That's awesome. That's awesome to hear. In fact, I always tell people, make sure that you're using the content, using the information. Hero's been a long-term trader and a member of Team Tackle with us. So great job there, Coach Hero. Matt, final thoughts from you, and then we're going to wrap this whole thing. What you going to be paying attention to the rest of the day?
I think like everybody else, working off those watch lists from the scatter reports. If one day is an indication, yesterday was a really good start to those scatter reports. A lot of potential triggers, setting up on Monday as well as today. I'm going to work off those reports for the better part of the rest of the week. I mean, I remember going through those scatter reports on Friday and just combing through literally every stock in the market. And, obviously there's setups that, happen midweek in the market, but a lot of that work that you do throughout the week is done on the weekend, getting ready for your business, on Saturday or Sunday, spending a good 30 minutes to an hour, just preparing for the week every single week. And the reports are, ever since we started doing those scatter reports, that's, where I start. I work off those lists. And so a lot of those stocks, the distressed plays, they're starting to confirm, starting to pick up a little bit of momentum to the top side. Intraday speaking, you're starting to see a little bit of strength, starting to, form in the S&P after that initial sell-off at the cash open. So, it looks like we're going to, retest the highs from earlier last week, and you got to trade with that. But the one thing I'll say, and I said it during the halftime report yesterday, and I said it during the podcast as well, whenever you get an environment like we're seeing, really kind of start forming on Friday, holding at support level on Monday and then confirming today. Whenever you're in that moment in time where you're looking at a bullish retracement or you're looking at those distressed areas of the market, there is some potential really big return right now. There is absolutely no doubt about that. If we retest, if all we do is retest the highs from earlier last week in the airlines and the cruise lines and the energy stocks, if all we do is retest those highs, there's a lot of money to be made in that environment. Because of the percentage of the retracement we saw in that bullish retracement that started last Thursday. But whenever you have the opinion or the analysis that leads you to a big time opportunity in the market, that always accompanies risk as well. And what I said on the halftime report, and I hope you guys viewed that for on the recording. We're sorry we couldn't go live. We tried for like 15 straight minutes. Like, Tim, you try host, you try share. No, Matt, you try host, you try share.
It was comical.
It literally, it was Three Stooges. It really
was pretty comical, actually.
Cody, it was the Three Stooges trying to figure out YouTube and Zoom yesterday. But, thankfully, Cody figured it out. We got live today. But what I said on the halftime report yesterday, and what I said in the podcast, and I hope you guys enjoy the podcast this week, is whenever you have a moment in time like this, where you have a quite substantial retracement sitting at a support level, you're obviously going to have an increased return potential right now. That always accompanies increased risk. And in my opinion, the best way to approach this opportunity is to, dip your toe in a little bit. And what I mean by that is scale in. If your normal position size is, say, 3% of portfolio in a trade, maybe you take a 1.5% position size
And as we break out, you add to it. Or as we start to see momentum, we add to that position. So I think, scaling into positions right now, starting yesterday, coming into today, I know you mentioned your square trade on Hero on the breakout. Love that. As we start to confirm and start to see momentum build up, at that point you want to add to position. So this is a great moment in time. But but with that said, you also have increased risk, increased volatility, increased whipsaw action. Trade with caution, be conservative. You want to be a trader for the next 20 years, not the next 20 minutes. Be cautious, be conservative, keep position sizes tight, add to positions as they start to build momentum.
And by the way, I mean, the way to play all these things, Matt, we were talking earlier, you had a really, really, really insightful comment. You said, hey, listen, I like long equity right now instead of just long options because the VIX and the premiums are so high. If you're going to play in the options market, theta, more advanced strategies, different ways to play it might be the better way to play it. And I'm just not saying, go ahead.
And it's not just that, Tim. It's, if all you're doing is buying call options right now, I honestly feel buying equity is better. I truly do believe that. The volatility in the market is just, you're paying so much premium to get in, so much premium. And if it stagnates a little bit or volatility comes down a little bit, even if you're right on the directional nature of the play, you still could break even or lose a little bit of money. So I do think with the increasing volatility in a directional swing trade, you're probably your best bet, in my opinion, is probably equity. And for some newer traders, yeah, but equity is expensive. Well, you don't have to buy 100 shares, guys. I mean, that's not, you don't have to buy 100 shares of Amazon. You can buy one share of Amazon. I mean, it's damn near impossible to trade options from a directional nature on Amazon. It's almost like you're forced to buy equity. And I'm seeing that a lot in a lot of these potential trades. So it's okay to only buy a few shares if that's, fits your position size rule in the market. If you know how to do a little bit more advanced strategies, on these retracements, bull put spreads, a wonderful, wonderful way to cash flow in a market off a retracement, where you have a little bit of hesitancy, a little bit of caution, whether it's going to, really move in your direction. Selling a deep out of the money credit spread like a bull put spread, taking advantage of the volatility makes a lot of sense to me. If you're looking to trade it from a directional perspective, instead of, outright just buying it at the money call option, or, like you did on Boeing and out of the money call option. I loved, it wasn't the tackle today, but there was a post. I can't remember who did it.
Go to the YouTube chat. Yeah, no, I did it. It was a YouTube video. In fact,
the pros and cons of buying out of the money call options. Mm-hmm. And there are pros and cons, right? I mean, when you first teach a student trading, it's you buy a 0.5 to 0.60 delta contract. That's for new traders. Obviously, veteran traders are going to find different ways to take advantage of the options market. But my point is this: if all you know how to do is buy call options, I would recommend looking at equity right now in this environment a little bit more strongly. Number two, if you do have an advanced understanding of the options market, selling a 10 delta bull put spread on some of these high volatility plays can be really, really, really good in this environment. Getting a little bit of range, additional probability, taking cash flow instead of directional nature, that makes sense to me. Also doing bull call spreads, diagonal spreads, other type of spreads where you're not just buying something, but you're also selling something to offset the cost, selling something to bring in that premium. That makes sense to me as well. But buying directional call options, directional put options, I mean, maybe they'll just outright outlaw put options at this point, but buying directional options in an increasing volatile condition, you better be right on the projection. So I think adjusting your systems a little bit to fit the volatility of the times makes some sense.
Yeah, I 100% agree. And bull call spreads are a great way to learn. Guys, thanks for being a part of our show here today. As always, we appreciate you guys. Noah's showing the video that he posted. If you've not had a chance to watch it, I'd like 280 views there in one night there, Noah. So pretty good.
Not too shabby. At least my son didn't photobomb us naked this time. He only got in there. He was fully clothed this time as he came in. Let's see if I can pop him in there. He shows up here somewhere near the end. I can't remember exactly where he was. But yeah, my little guy came in and photobombed it. So I'm just glad he had pants on.
Dude, how old is your son?
3.5.
My nephew, he's 2.5 or almost 2, actually. He's not quite 2 yet. But we've been babysitting him several days a week, and he's been coming into my office more and getting much more interested in what I'm doing. I'm guessing we're going to have a photo bomb at some point. Look at that dude.
Well, the best part is this is the little dialogue we get to have. You guys hear that?
No, but it's okay.
Volume.
They can go watch the video.
You got to hear this. You got to hear
Yeah.
this. This is good advice, actually. So hold on. Let's go up to that share with sound, and we'll get her there. All right.
Buy out of my call map.
No, I don't have to do that. But here, tell everybody here. Say, don't buy out of the money call options
Don't buy out of my call map options
because it's a sucker's bet.
because it's a sucker's bet.
That's right, sucker's bet. Okay. Of course, that's all contingent on the delta you buy, 25 or less, or 25 or more. Excuse me.
No, listen, who am I going to sell out of the money call options to on occasion if there's
Sorry,
no
I don't mean
suckers to buy them? You know?
It's a sucker's bet. You know.
We need to isolate that, pull that, and get that out there on Twitter. That is amazing. Unbelievable. And that kid's in your office a lot. No, he's going to grow up and become a technician. You watch. When he's interested, you
He's
never
going to
know.
start outperforming his dad by the time he's 5.5. What are you talking about?
I remember once, Matt, you had that old video where Cat would do technical analysis, and kids can read charts and patterns.
Well, and now's the time to indoctrinate them. I mean, really, it's get them when they're young. You can teach them anything you want.
Yeah, very cool, man. Very cool. All right, guys, I dropped the link for the pro membership in our chat. If you know us and you haven't tried it yet, give it a shot. If you're an old member that is looking to come back and learn charting and trading and get back in the game, we're always here for you. Give it a shot as well. 15-day trial, standard offer. Come and join us. And then we've got a show tonight, Coach Show with Noah and Greg Holmes. That's it for today, guys. We are out. We will see you tomorrow.